Welcome to the second installment of our technical analysis learning series. In this video, we delve into one of the foundational patterns in technical analysis, which is triangle patterns. Whether you are new to trading or looking to expand your knowledge, this beginner-friendly explanation is best for you because we break down the triangle patterns, their significance, and how to identify and interpret them on price charts. Join us as we unravel the mysteries of triangle patterns. So, what is a triangle pattern? Triangle patterns are a group of candlesticks that form a general chart pattern over time in the formation of a triangle. They can be ascending triangles, descending triangles, or symmetrical triangles. So these are the main three triangle patterns you will find on any chart. Okay. So for all intents and purposes, the simple way to spot one of these is to draw a trend line across the top and bottom of the recent price action of the asset in play. If you find that asset coiling into an apex, it is likely forming a triangle pattern. These can be called by different names. Some like to call them pennants, others like to call them wedges. Aside from maybe a few nuances here or there, they are basically the same chart patterns. They resemble a triangle. How to read a triangle chart pattern? Triangle chart patterns begin with a broader price range and volatility. Over a period of time, they contract into an apex on the lower volatility and narrowing price range. This is accompanied by a series of higher tops and higher bottoms, or lower tops and lower bottoms, or a symmetrical sideways pennant of lower highs and lower lows. Some variations to this can occur, like a flat base or flat top. One thing to note is that regardless of the formation specifics, the goal as a trader is to determine the path of least resistance once the asset leaves the formation. Sometimes it can break the other way also. It is not like 100% infallible pattern. So volume and price actions are key in how to read a triangle pattern. We will look into much detailed explanation of each type of triangle pattern. Okay, each pattern will show you, if you look intently enough, of the path of least resistance on the horizon. Once you spot it, the triangle pattern gives you a great risk to reward setup for your trade plan. It is in fact true that this kind of patterns sometimes fail, but whenever we get the right entry in a pattern like this, that will be the best trade you will take compared to the risk reward ratio. So in order to identify these trades, we need to first identify these patterns. So we need to learn how to identify these patterns first. We are going to look into descending triangles now. So as you can see, in a downtrending market, the price swings higher, then it is making lower highs, lower highs, lower highs. Even though it is not making lower lows, it is making steady lows, and it is making lower highs, lower highs, lower highs. Eventually it is contracting into the apex. Okay, once it breaks out, you can place your entry there, and you can either put your stop loss on the previous highs or just above those levels. Depending on your risk ratio, you can put your stop loss there. Let's look into an example. So this chart shows Bitcoin. As you can see, it has beautifully respected this pattern. It has made lower highs, eventually contracting into that apex, and once it breaks out, it has exactly played the measured move. Now we look into ascending triangle. So this is the reverse, the opposite of descending triangle. As you can see, in an uptrending market, suddenly a huge price swing occurred. Then the price action gradually contracted and contracted and contracted. Once it reached the apex, it breaks out and the exact measured move is played out. You can see I have the dotted lines marked there. So let's quickly look into an example for this ascending triangle. As you can see, it has respected the upper trend line and lower trend line, and once it reached the apex, it broke out and measured move was played exactly. Looking into another pattern, which is symmetrical triangle pattern. So this is the most trickiest pattern of triangle patterns. Symmetrical triangles can break 50-50 to either side. We cannot be 100% sure that it will break to one side. Even though we are in a uptrending market or a downtrending market, we cannot be sure that it can play out exactly as we expect it to. So we need to be very careful when we see a symmetrical triangle. Usually we find it bullish or bearish depending on the market structure, but we cannot trust this 100%. That's what I have to say. I'm going to show you some example. As you can see that in this uptrending market, we would expect this to break upwards, but what happened? It broke down. See, That's what I have been telling you earlier, that even though it's in an uptrending market, it doesn't have to break towards the upside. Now in this example, it broke towards the upside. Okay, as you can see, a huge swing move, then contracting towards the apex, and then we broke out, and the exact measured move is played out. So that's how you need to play a symmetrical triangle. So we have already covered all three patterns. Now let's summarize. Technical analysis categorizes triangles as continuation patterns of an existing trend or reversal. Now the most important point. Triangles are similar to wedges and pennants and can be either a continuation pattern if validated or a powerful reversal pattern in the event of failure. Suppose you are playing out an ascending triangle. The price reaches the apex, it breaks above the upper trend line, and it fails to hold that upper trend line as support. It comes back inside the pattern. Then we can expect all those people who entered the breakout trade, the price will take out their stop loss, which will in turn drive the price to the opposite direction even quicker. There are three potential triangle variations that can develop as price action carves out a holding pattern, namely ascending, descending, and symmetrical triangles. Technical tools are meant to help make predictions about future trends based on past performance. But remember that the market can be very unpredictable and can swing in any direction at any time. So make sure you learn how to trade these kind of patterns. Thank you for watching. We'll come back with another video soon.